the marketplace that we have today is, I think the word I would use is uncertain. And uncertainty brings a lot of disruption to the markets, particularly the financial markets. Financial markets are driven a lot by human behavior, psychology, we call sentiment, right? What people believe. And beliefs drive that to a much greater extent than they drive the alternative investments, which is where a big focus that Dave and I have. It doesn't mean you shouldn't be in the financial markets, and we're not saying where you should be tonight. We'll give you some frameworks. But I believe the uncertainty is driving a lot of the volatility we're seeing today. That plus we've had a major administration change, obviously, in the last few months. And with that, a lot of disruption coming along the way. President Trump said within the last week, when he was being interviewed by, I think it was Maria Bartiromo, said to her, she asked him about recession. And he said, I don't really want to use that word, but he said, we're in a period of transition. And he said, we're doing big things. Well, they are doing big things. Like it or not, they're doing big things. They are disrupting at a rapid pace. And Scott Bessent, the Secretary of the Treasury, also made a comment in the last week, and his words were detoxification. So nobody's using the word recession, but you can put your words around it if you want to. Obviously, we have much volatility in the marketplace. We've seen the equity markets have been stretched to major extremes. The price earnings ratio really at all-time highs right now. So the marketplace, the financial marketplace, I believe, is extremely overvalued. Like everybody's in the market, and there's so much passive investing, so much 401k money, IRA money. Retail investors it's easy for them to be in the markets. And when the herd mentality drives into a certain asset class, it, along with the monetary and fiscal policies, just drives these bubbles. And whenever you have a bubble in any marketplace, any asset class, there's a concept, and it's not an opinion, it's a fact. It's called reversion to the mean. It means the higher or the lower a marketplace and asset class goes, there's a mean that it will revert to in time, and we can't predict that time. But it's going to revert eventually. And so if a certain asset class has been driven to extremes, then we have to contend with the fact that at some point it's going to drop down. The question is, what do you do about that? And again, that's going to be part of our context this evening. Obviously, we have interest rates and inflation, debt, national debt, deficit spending, which hopefully is going to be restrained some, but we don't know. Congress is historically known for spending a lot of money, right? We have the tariffs, which again, trying to reshore manufacturing here, but that has an inflationary context to it as well. Real estate, commercial, residential is certainly been showing that it's tipping over. Demographics. Very few people talk about demographics, but we have globally aging populations. What does that do to the workforce? What effect will that have on the economy overall? We also have geopolitical risks that are minefields that could explode at any time. Which again, any of these areas, which I see as kind of canaries in the coal mine, could be a factor that could disrupt to the point where there could be a domino effect. Again, I'm not predicting that. But I believe we are in a period of time where we are in a lower growth and a higher inflation period, which again, the words I use for that, which I didn't coin, stagflation. Jerome Powell wouldn't say those words, but he did say higher inflation. He said lower growth. So I'm going to stop there and turn it over to my friend David McAlvany to provide his context. David, go ahead, please.
Thank you, Dr. Phelps. Good to be with you tonight. And to have some perspective on where we're at and where we're going, I think is really key. The financial markets run in cycles, and the economy also runs in cycles. The business cycle used to be sort of a 3 to 5 year trend, and we've extended that trend through significant intervention by monetary policy, the folks at the Fed or other central banks around the world, and it's extended the growth trend. The most recent trend, both for the economy and for the financial markets, has been running very strong since 2009, coming out of the global financial crisis. And you move from undervaluation to overvaluation, back to undervaluation. That's kind of the cycle. What Dr. Phelps was referring to is mean reversion, and it never finds stasis. You just have to figure out where you're at in the cycle to appreciate the kind of risks that you're taking in a variety of asset classes. Are you in the early stages of a cycle, or are you in the ninth inning? And on that basis, you can better appraise the decisions that you have and the allocations that you make the risks that you're willing to take in a given environment. So we see the economic statistics still coming out reasonably strong. Even this week, we had housing starts, which impressed to the upside. We had industrial production, which surprised on the upside. And so at this moment, there's not a reason, to hit the panic button in terms of the economy. Where people are concerned is that we are on the edge of re-engineering the economy. The new administration would like to take us to a different place. We have been consumption oriented in terms of our growth. 70% of GDP is tied to consumption. And we've benefited greatly from importing a tremendous amount of goods. We've had the privilege of having the world's reserve currency. And so when we buy a lot of goods from overseas, it's motivated corporations to send production overseas so that we can buy that many more goods at a cheaper price. And the new administration wants to take us a different direction. They want to focus on job growth, but really healthy job growth. They want to see us manufacturing more. They want us to be more mercantilistic than we've been in many decades. And that re-engineering, both of eliminating government spending as a huge percentage of GDP and imports, shifting that to being more balanced with our exports, is what they're trying to accomplish. That puts a lot of people into a state of unease. That uncertainty that you referenced, Dr. Phelps, is what's being felt in the financial markets. We don't know what's going to happen next. We don't know how soon the implications of tariffs are going to impact the economy. Is it going to be a positive impact or a negative impact? And that uncertainty certainly is sort of it's having an effect on investors as they rein in some of the risk. But you're right in pointing out we're at the end of a cycle in terms of the financial markets. We have valuation metrics which are 2.5 to 3 standard deviations from the mean, which is to say they are at the highest levels. If you're looking at all time, they're at the highest levels that can be accounted for in, say, 99 to 99.5% of the time. So literally the financial markets have never been this high, or they've been this higher only about 0.5% of all financial history. So we're in the rarefied air of overvaluation. The Buffett ratio would be one metric to look at. Warren Buffett loves it. And he would say, okay, you take the current valuation of all equities, compare that to the economy. And if it's 100%, basically a 1-to-1 ratio, it's pretty reasonably valued. At 200%, it's very overvalued. And at less than 100%, things are undervalued. We're at 205% at current market numbers. And that would explain why Buffett's been raising cash. That would explain why he has the largest percentage cash allocation in the history of Berkshire Hathaway. That's a bit of wisdom I think you should probably take note of and probably employ yourself. And it's not because you have to be incredibly bearish, or if you by personality tend to be more positive, have to somehow disavow who you are, disconnect from who you are. The cycles don't care about you. The economy doesn't care about you. The financial markets are not in tune with your retirement timeline. And so it just is important that you understand where you're at in a cycle so that you're not overextending. And if you're overextending, then you may find that you have to play the patience game for a long time just to recoup value lost. So we are at an interesting inflection point in terms of the financial markets. We would expect to see a significant drawdown in equities. What we've just seen is the beginning, not the end. And the economy, I think that we have very hopeful prospects in terms of this reengineering, but I think there is going to be a time gap, and it could be an 18 to 24-month time gap where we go into recession. We experience a significant downturn before things get considerably better. And so that in a nutshell is where I think we're at and where we're going.